Let's call the investment committee to order. Lamont, can you do roll call for us?
Of course. Good morning. Controller E. Ms. Dillon. First State Treasurer, Mr. Boykin. Here. Ms. Vargas. Here. Mr. Rosensteel. Here. For the State Superintendent of Public Instruction, Ms. Zumot. For the Director of Finance, Ms. Ortega. Ms. Higa. Madam Chair, you have a quorum.
Excellent. Thanks, Lamont. Item 1 is the approval of our committee agenda. You can see our 15-16 work plan. This is an action item, so.
Move approval.
Second.
Excellent. All those in favor say aye.
Aye.
Opposed? Great. So, Chris, CIO report. Give us a scoop.
Welcome everybody back in the room. Sorry it was such a long closed session, but we had a lot of important stuff to talk about. And we were not talking about you. First off, I just want to run through a couple of slides on the portfolio to help everybody. Dr. Sandy Keaton already asked me this question today. So, Dr. Keaton, the portfolio is at $187.8 billion. We had a very nice October. As somebody said, it was not a trick, it was a treat. It was a big recovery from where we were. And we're back to where we're basically at a break even, almost a positive return for the fiscal year. Again, keep in mind that we don't have to get back. We started the year at $191 billion. We don't have to get back there because we pay out $500 million every month in benefits. So the portfolio could actually shrink during the year and we'd still have a positive return like last year.
It's $12 billion a year.
$12 billion a year in net cash flow?
No,
Or benefits,
It's
but
$1 billion
net,
a month.
I know, net cash flow is $500 million, less contributions. Here's the asset allocation as of last October. This is unreconciled, so these are estimated numbers. But as we've talked about many times, the equity exposure is almost every asset class is on the mark. We are underweight private equity. We're aware of that. It is a very slow-moving asset class. Decisions we made there back in 2011, 12, 13 have more to do with where it is today. But the board discussed that already today in closed session a bit about where we want our strategy to be on that. Here's a picture of the Russell 3000 since June 14, so not 15, but 14, so about 2 years ago. And I drew a line just to kind of give you an idea of what happened to us in August and in September. We went back to the lows of September 2014. That's significant because 14 was when we had the great federal government shutdown. Not a great shutdown, but it was a shutdown. It was the great default. So bad choice of words, I guess. But we recovered very sharply after that last year. And it was interesting that we went down to almost those same levels in the Russell 3000, but have recovered back very nicely here most recently. But this is a good example of the seesaw pattern that we told you we thought was going to happen in the market, and also just the lack of momentum that we're seeing in the market. So, but let's step. So here's basically almost 2 years of time period. Step back and look at it over 3 years and you get a whole different picture. And what is surprising is you can see now the volatility in the last couple of months, but how we've had a really strong run up leading into that. So again, here's the last 2 years, but then when you look at a full 3 year picture back to 2012, very strong cycle. But I think what we've been talking about is we think the market is not necessarily rolling over to then decline, but it's definitely lost momentum and is in a flattening stage. Here's a different look. This is the MSCI World Index. So this is all the stock markets in the world, and really gives you an idea of how in that same time period of 3 years, they've not had as much of a strength as the U.S. market and really have more of a choppy period most recently. Here's zooming in, whoops, pardon me, there we go. To zoom in more of a time period, you can see that in the last 2 years, we've had a very choppy time in international markets, mostly as we discussed because of the difficulty in Europe and then the flatness that we've seen in Japan. Japan had a nice rally, but has really struggled. This is an updated chart of GDP around the world. I think the key thing that I would focus on is, you're looking for dark green, bold green, and dark green spots, and you can see there are not many. The few that are there are in sub-Saharan Africa. Most of the developed nations led by the U.S. are in very slow growth mode. And then obviously with China and Russia, those are question marks about their economy, but the International Monetary Fund forecasts really show that those economies are slowing dramatically. So look at this as the pace of growth, what they thought it was going to do versus what happened. And you can see that's why we've said there's not a lot of strength to the international markets in this time period. My positives and negatives have not changed a lot. I would really say the biggest risk that has come of light that we've heard about since the summer is the fear of global deflation. If you look at our portfolio, that would be a bad thing. Be a bad thing for almost any physical asset. But we think that there are so many economies trying to stimulate some level of inflation that is a less of a concern. On the positives, I really almost questioned whether I should put these neutral instead of positives. The Federal Reserve has been in an easing mode, but obviously we know they're going to tighten. Glenn has told you as a fact they will tighten. He just didn't say the date. He just won't mention the date, but we know they are going to tighten. GDP is really dropped. It is probably about 1%, so it's a positive, but boy, barely. And the low interest rates right now, I think, have almost become a problem for the economy, not a positive. So as we discussed at length, assets we think are at full value, fairly priced. Stocks are fairly priced. Bonds certainly are rich, overpriced. Real estate's fairly priced. Private equity is more than fairly priced. So it is very difficult to find things that we think are a bargain in this environment. Places like Greece, Portugal, are a bargain, but there's a reason they're a bargain, and we're not willing to buy into those markets at this point. One thing I want to highlight on the pages in front of you would be INV 26. Again, I want to give out a shout out to Stephen Tong, Josh Diedish, and the risk team who's here in the audience. Actually, can you guys stand up? I think I did that to you last time. Slowly, stand up. There we go. But these three people are the build out of our risk team. They did the scenario analysis on INV 26, where I think it helps you look at, okay, what if oil prices go up, flat, down, interest rates up too quick, not up fast enough. And these are just rough expected returns in the portfolio. Clearly, the biggest driver in each scenario is what happens to global growth. As we have said to you many times, 85% of our portfolio is driven by global GDP growth. So interest rates and oil prices, how they impact global growth and the direction of global growth, that's really what's going to drive the portfolio to have a double-digit positive or a double-digit negative return. But I also want to point out they can customize this report, so if there's additional information you want to see in here, I pointed out before on INV 25 is the concentration portfolio, either by individual holding or by manager. They can customize this package any way you want. And I think, in fact, somebody asked for the scenario analysis last time, so just want to share that with you. Questions?
Any questions from the investment committee? Great report. I did really like the scenarios. I thought that was really helpful. So I thank the team for that. I think that helps us kind of sort of get into your brains a little bit in terms of how you're looking at the global market. So that's it. Thanks, Chris. All right, so we're moving on to item 9, which is the proposed minutes from our September 2nd Investment Committee meeting, open session. Any edits, comments?
Second.
It's been moved and seconded. All those in favor say aye.
Aye.
Opposed? Abstentions? Great. Lamont, approved. Okay, we're moving on to item 10, which is our 2015 Asset Allocation Study, Part 6. It's sort of like, it's... How many Fast and Furiouses have there been? 8, 7? I don't know. I've never seen one, but there's a lot of them. So this could be our Fast and Furious. This is part 6, and I just wanted to introduce it, and I'm going to ask for the board's indulgence because, to Tom's point about having a structured conversation, I'm going to share with you an idea I have for the structured conversation for item 10. And what that is first we're going to hear from our consultants and our staff, and you're going to present to us information about this piece of the asset allocation study. It is an information item, so that's just of note. We do not need to take action on the item today. But I just wanted to mention how we're structuring it is we're going to have the consultants and staff present. This is going to be tough for us as a board, but I'm asking the board to actually refrain from asking questions until the end of the presentation, if you can. So if you can take notes to yourself, and we'll make sure that the board gets a chance to interact. I will say we've worked really hard before this item to make sure that all the board was able to ask questions ahead of time. So I do think we've had some good sort of good opportunity and time as a board to wrestle with some of the questions in this item. It's a really important part of what we do as fiduciaries of the system. So I'd ask for us to kind of wait. We're going to have the presentation, and then for those in the public that want to make statements related to the asset allocation study, not related to other topics, but related to the asset allocation study, we're switching it up to make sure you're not waiting till the very end of the meeting. So we're going to actually have statements from the public after we have the consultants and staff share related to the asset allocation study. So if you want to make a statement from the public, again, there's what are they called? The little notes in the back where you write your name and you say where you're from, and if you want to make those statements, you're welcome to do that. But we just wanted to give you a heads up since this is kind of a different order than we normally do things. And then we're going to just take a quick break, and then we'll come back and we'll have Harvey Lederman, our fiduciary counsel, help us as a board think about how this item relates to our fiduciary duty, because that's always good for us to begin our conversation. And then the fourth part of our conversation is going to be our always vigorous board discussions about the item. All right? Does that sound okay? So that's kind of the 4 parts. So we'll start off with part 1, staff and consultants. Take it away.
As we start and introduce, and most of the people up here in front of you know quite well, but this is partially for the board, but I have to say a lot of it is for the teachers in the back of the room because they haven't heard this bigger picture look at it. I've been saying to the board for quite a few years, more than 10 years at our offsite discussions, that our asset allocation does very well in high growth periods and moderate growth periods. And I just going through that, what we looked at was 85% of our portfolio is exposed to global GDP growth. So in decent economies, we do great. In good economies, we do okay. But in recessions, and I'm not talking about 1991 or 94, I'm talking about 01 to 02, 08, and probably if we'd been able to look back at 1973, 74, our portfolio doesn't just do poorly, it does terrible. It really gets hurt. And this whole discussion on this asset allocation study was really started 3 years ago in the last asset allocation study. It was, hey, what's going to happen to us if we have another 2008 occurrence? And the big thing that changed between there now and then, our cash flow has gotten more negative, so we've gotten more mature as a plan. But the big thing that really changed the landscape was the funding strategy. Jack and you and the team really pulled through so that now we can look at the system and say, hey, we're going to be alive in 2040. And what we want to do is actually set a path to be fully funded. So last fall, we looked at what could happen to us in that marathon running at that average race of 7.5. What if we tripped and fell and had a 2008 occurrence again? And the answer was, you know what? You fall into a hole that's almost too big to climb back out of. Rates would have to go too high. You'd have to take on too much risk to get out of it. So what are things we could look at as a plan that would help soften that downside risk, maybe reduce that? So picture a distribution curve, a bell curve of distributions. We don't care about the right-hand side. That's all good things, and we want double-digit returns. What we care about is the left-hand side. What are the negative outcomes and what could hurt us in the plan? And if you think about that in life, we all celebrate the really good times when the Jets win, The Mets win. That's the, maybe that's a.
Ms. Dalman,
Don't-
Ms.
it's too
Dalman,
soon,
we were
Chris.
having a good day.
Too soon.
Let's keep it that way.
Too soon.
You shall not refer back to the Mets.
They got to the World Series. So when they're in the World Series, that's a right. That's a.
And I lost 30 days of my life following them and was disappointed once again. But there's always next year.
So those are the positive right-hand tail events that can happen. The left-hand tail events. When you think about those in life, you buy insurance. You gladly pay a premium for your life insurance, your auto, your fire. You buy a whole bunch of insurance policies to protect against those outcomes. We can't buy an insurance policy, but what we can do is invest in things that would help us so that those outcomes aren't quite as bad. And that's what this whole exercise has been about, is taking our existing asset allocation and trying to find a way to make it a little bit better. You asked these consultants and staff with all the different models they came up with in September to get on one page, come back to you with two options. And we have those two in front of you. One is, out of all those options we looked at, our existing portfolio is actually the best. So if you want to do anything, don't do anything, you stay with the existing portfolio. The other option we came back with is, if you worry about that downside, those bad events, there is something you could do to soften those, and that's your other option. So with that, I'm going to turn it over to Alan and the team, and they'll present as a group. Alan? Pension Consulting Alliance slides, there you go.
Good afternoon.
Hit the microphone.
That was bad. That was really bad. I hope I don't get electrocuted. Some people would like that. Some people would like that. I have family members who would benefit if that occurred. Matter of fact, I think they pray for that, but I'm going to outlive all of them. Chris has done a good job of summarizing things. I want to make some points because I think there are some really important issues. First and foremost, more people worked on this than any project I've ever worked with at this institution or any other institution. You had 2 consulting firms and a whole group of people on your staff who haven't spent hundreds, they've spent thousands of hours trying to answer the very good questions and challenges that have been posed by board members and by stakeholders. This committee raised a whole series of excellent, thank you, Chris.
Keep talking, keep talking.
You know, can't take me anywhere. A whole series of really good issues. And both the staff and the consultants have met with stakeholders and answered their questions to the best of our ability. Maybe not to their satisfaction, but we've done the best job we could to answer specific questions. And without question, and I can honestly say that I have participated in every single asset allocation study that this institution has ever done, this is the most comprehensive, the most interactive, the most public, and the most debated that I participated in. And I think that is a wonderful thing because it is the single most important decision that you make as an institution affecting the investment portfolio. Everything else pales. Active versus passive, fees, diversification is the key, and that's what we worked on. You tasked us with coming up with 2 recommendations. Either one of them is viable. The modeling does not compel you to do one or the other. You have a choice, and I think that's what you directed us to do. Either one of those is legitimate. The difference, the big difference, as Chris mentioned, is the allocation to what we're calling the risk mitigation strategies. I want to refresh some of your memory, and for those of you who are new to the board, this issue of downside risk was discussed at great length at your November 2014 retreat. And in fact, what we were told was we don't want to address it now, we want to address it as part of asset allocation. Why? Because it was going to be incorporated into the actuarial study. So we're doing exactly what the committee instructed us almost exactly a year ago to do. But as Chris said, we've been concerned about focusing on downside risk for a long time. This is not new. The other thing that's very important is we recognize the importance of trying to achieve, on average, the 7.5% interest rate assumption. Either one of these two solutions statistically provides that 7.5%. So the big difference is this RMS risk mitigation strategy. It has 4 sleeves. Some of them are really easy to understand. Well, really, one's really easy to understand, and that's long treasuries. The other 3 are types of management, or they are approaches to managing assets designed to do well when the equity market does not do well. And they are also designed to not react to economic events in the same way, so that within those group of assets, they're diversified. The sole purpose of this portfolio is to change the outcomes in very bad events. And that incorporates periods like 08 and 09. And that becomes more and more important as you have more and more negative cash flow, and as the population of the whole system matures. The ability to recoup losses becomes more and more difficult. And it's not that average return that matters. It's the path of that average return. And that is, if you in the early years have a series of bad events, it could make obtaining the long-term objectives next to impossible. Luckily, you can't read this, I can't read this, and the audience can't read it, so I've learned long ago not to go into detail when people don't know what I'm talking about. What we did, though, for the audience, I'm going to get off the page so you're not stuck there. What we did was we looked at different combinations of these 4 components. And what that does allow you to know that there's not a way of creating this portfolio to obtain that objective. You can do it with different combinations, different weights, including or excluding different components. What's important is the concept. And I think I can say on behalf of the staff and on behalf of the other consulting firm, we all believe that it's the concept of developing a risk mitigation strategy which is important. How it's structured is a secondary issue. All of the structures improve the ability to do better at the margin when things go south. And it's important to keep that in mind. This does not mean you won't have big negative returns. In a really bad event, you will have big negative returns. The question is, are they less bad than they would have been otherwise? And if it is, that's a really good thing. Depending on how you configure the components, there are a variety of ways to do it where, in fact, it is fee neutral, given the existing ways it's managed. That would mean you'd have to exclude one of the components, but there are ways to make it fee neutral, and there might also be ways to make it fee positive relative to the newest cost. What's most important is the lowest cost one is treasuries. You currently buy treasuries. You can buy them and hold them at at no cost, effectively, other than a monitoring cost. And the most costly is the global macro. But what's important from my perspective, and I think all of the panelists share that, is the concept. Is that if we were given the task of saying, yes, you as the board accept this as a concept, bring us back alternatives to look at, I would view that as a really, really good step. How long will it take? Assuming you adopted the asset allocation with RMS, to implement it's going to take 2 to 4 years. It's not going to happen overnight. And in fact, there'll be a learning curve for us, for you, for the public, for the stakeholders, and things can change over time. You might go more quickly or more slowly depending upon how events come about. All of the vehicles that would be invested in are publicly traded and are have broad, deep markets. So you're not going to be investing in illiquid, hard-to-sell assets. You currently, for many of the strategies, for all of the strategies, you currently have some exposure in your existing portfolio where your staff has hands-on, in fact, not just hands-on, but hands-on positive experience, approximately $3 billion in market value, and they're going to get into that performance. And their performance, in fact, is consistent with the assumptions that are used in the modeling. And it's important to keep in mind, each of us modeled this independently. So you had 3 different models going on and thousands of hours, and we all reached pretty much the same conclusion. That's my introduction, but I want to underscore the importance of the concept. And even though we'll talk about the components and answer your questions about how they work, we would urge you to address that structure issue, saying, yes, give us the concept and come back with how to put the pieces together. Thank you for your time.
You did. Don't touch it. Don't touch it. We have insurance, right? We have...
You can take that off my feet.
We will.
All right.
Next, we're going
So
to
who's next?
Steve McCourt
Steve?
Makita once we bring up his presentation. Takes the water away from him.
Yeah, hopefully they short it out.
Great. Thank you. And I'll start by just echoing all the comments that Alan made. This is the second presentation I intended to go through, but since it's up now, there's one slide I was intending to highlight and will highlight here. Alan mentioned that the concept of the RMS asset class is our best way to mitigate downside risk, particularly tail risk, over the next 30 years in the pension plan. It's impossible to get 100% confidence of any asset providing downside risk. And so what we had done, as Alan mentioned, independently is model how the 4 components in the asset class have behaved historically, given the data set that we have, probably most critically the 2008 and 9 financial crisis. And so what this chart here shows is the rolling 3-year returns of the S&P 500, which is the probably the biggest risk factor in terms of a broad index you have in your pension plan, and the rolling 3-year returns of the RMS asset class is based on the indexes that we use to proxy the strategies going back in time. And the point of this chart is that these strategies have historically provided, in the aggregate, a much more stable return pattern. But as we've highlighted before, and I'll highlight again, this isn't a free lunch. These are not intended to produce returns over long periods of time as high as the S&P 500. They simply are intended to provide a more diversified source of risk mitigation than fixed income assets represent today. So I think I have another presentation that should be queued up on the asset allocation modeling. There we go.
It's not 33 slides, right?
Excuse me?
I'm just saying it's not 33 slides, right?
No.
Okay.
I'm only going to go through.
I just want to make sure.
Yeah.
You know us, Stephen.
Yeah. So I'm going to just go through a couple of slides and go through a summary slide on this. As Alan mentioned, the the results from the model are consistent across us and staff and PCA, that the both portfolios are good portfolios. Both portfolios can be expected to achieve over a long period of time the 7.5% return objective of the plan. The portfolio with the RMS, based on a wide variety of analysis that was done, does at the margin reduce the risk in the portfolio. And this slide here shows the type of risk that it generally mitigates. You have less systemic risk in the portfolio with the adoption of the RMS strategies. And by systemic risk, we mean the types of risks that generally impact most severely global equity markets all at once. And so, as we learned from 2008, when bad stuff happens in the capital markets, correlations tend to go to 1 on all asset classes. And because except for U.S. Treasuries, most asset classes at their core are in some ways connected to economic growth. The RMS categories are not. And so these are categories that I think most reasonable people can expect will perform in a defensive way in a down equity market. Skipping most of the 33 slides here. I do want to highlight, while the risk return efficiency of the portfolio with the RMS strategies is clearly superior to the one without. These strategies, at least as modeled, would result in likely a higher fee load on the plan. And that's just something to sort of consider as you're making this judgment in the context of fees that you pay across other asset classes. And so finally, the final slide I'll go through is our best attempt at sort of boiling down the major decision factors here between these two portfolios. I also want to highlight, Chris introduced this topic as sticking with your current policy versus going with a policy with RMS. I do want to highlight that while policy A is technically your current long-term policy, it is modeled to eliminate the home bias in the equity portfolio. And I don't want to diminish the importance of that. That would result in roughly 8% of your plan moving from U.S. equities to global equities over the course of the next several years. And that's a powerful thing from a diversification standpoint and a return standpoint. And so there are advantages to doing that, and both of these portfolios would include that in the models. In modeling out the forward-looking funded status of the plan, the median funded status, based on our calculations, was 5% higher in the policy portfolio that included RMS, and that's about a $35 billion difference at the end of year 2047. So there's a modest return advantage. The volatility reduction, you can measure volatility reduction in a variety of ways. We estimated at about 3% improvement in volatility in down markets with the RMS strategies. The tail risk reduction is more significant. The 10th percentile funded status, which was our measure of a really, really, really bad event on your fund, the funded status of your plan is about 3 times higher with the portfolio with the RMS versus the one without. And then the two final characteristics, which if you consider RMS, should be considered as costs related to them. One is the management fees. Our estimation at this point is that the management fees would likely increase the fee load across the portfolio by roughly 4 basis points. And for a fund of your size, that's a big absolute dollar number of $75 million. That being said, I'll also echo what Alan said. We haven't worked with staff yet on the implementation of these, and so there's lots of opportunity to after this decision is made, determine ways to minimize that costs. The second, which I wanted, the second issue I wanted to highlight is the confidence in the assumptions. There's different asset classes with different performance histories associated with them, with behaviors across more economic cycles. And I think we want to acknowledge that these outside of treasuries, where we have a long period of history, most of the performance data we have for the three other categories of RMS go back between 20 and 30 years, as opposed to our history with U.S. equities and U.S. bonds, which goes back 100 years plus. And so, in any model, you should acknowledge that you're investing in the real world. You're not investing to a model, and that's one of the real world risks you should consider in translating the model results to your policy. So that was our best way to sort of create sort of a balance for you. This isn't an easy decision. I think I would say the same as staff and PCA, that these are both very good asset allocation policies. They both have the advantage of improved global diversification and the equity component. And it's fair to say, based on the modeling, that policy B has a somewhat stronger advantage to reduce downside risk.
All right. The other Stephen with the V. Carrie, Josh. You're going to present together, the three of you? Who's that? Okay. Okay.
I have 4 slides.
Okay.
Okay. So what I like to do is I like to begin just by introducing our staff on innovation and risk. And the reason why I want to do that was to give you an idea of really who worked on this project this entire year. And that's on the asset allocation study that you see, and this is the 6th part, as well as the RMS. So with that, I'd like to call up the rest of the team, and if you could come forward, please, and introduce yourselves. Go ahead.
I'm Matthew Topel. I'm an investment officer too. I've been at CalSTRS almost 3 years. For this, I was with State Street for about 6 years. CFA Charter Member.
I'm Angela Tran. I'm an investment officer. I've been with CalSTRS for over 3.5 years. And prior to joining CalSTRS, I worked at Piper Jackson for 5 years. And FRM over 10 years.
So I'm Josh Diedish, and I've been up here a few times. I've been here for 11 years and actually started here as an intern working for Chris.
Carrie Lowe. I started my career in investment banking and then equity research, convertible bond research. For 4 years prior to joining CalSTRS, I was at a hedge fund as a portfolio manager and really got to see the inside of a hedge fund, how to launch funds, how to run them, how to manage the risk, what are the operational issues, and that's really helped in our manager due diligence. And I've been at CalSTRS looking at hedge funds and many other strategies for the past 7 years with Stephen.
And as far as myself, I've been with CalSTRS, will be next year, early February, March, 33 years, believe it or not. And when I first started here, I remember the fund, just kind of a little history, it was probably about $14 billion. So I've seen tremendous growth. And I just related to what Ellen kind of shared earlier in terms of the asset liability study. He's exactly right, hit it right on. I think this staff, as well as the consultants, have been really engaged. And also just being engaged with the board members as well as stakeholders, and this has been really good. I think the product you see before you is really a product of the staff that you see before you and the consultants. And so this is really our best thinking coming forward to you. Can we go to the next slide, please? So next slide, what I want to do is sort of go over our framework and how we thought about risk mitigation, how it came about. So first thing that we kind of think about is really value creation. So it really comes back to what we kind of talked about earlier, is that 7.5% is the goal. But what we thought about is a lot of times we focus on returns. And so the other side of the equation that we want to focus on is really the risk side of the equation. And so we thought about was, can we get to the 7.5% returns, but can the path be smoother? So that if we face another event such as the great financial crisis of 2008, can we minimize the drawdown? Not that we won't have a drawdown, but can we make it less painful for the plan? So what you see before you today is a result of our thinking. And we're going to get a little bit into details. So the next thing I want to talk about is economic intuition. This is really an important area. So when we think about bringing strategies forward to you, as we kind of think about, one of the things that we really look at is its support in the academic literature. And the reason why that's important is that we want to invest in streams of income that we know that we can look back historically, and it has a history, but knowing going forward that there will be persistence. So we want to make sure that we're investing in essentially what we call risk premia. So when it comes to, now if we look through the academic literature and it's well documented, what we want to do is sort of test it. So you want to see the intuition behind it, the evidence behind it. Is it well supported? Does it achieve the results that we read about in the academic literature? So I just wanted to draw your attention to some of the information. So first of all, what I wanted to say is that when you look at RMS, I just want to clarify some key points so that you understand what the purpose of RMS and we can manage expectations. So the first thing I wanted to say is that RMS, when you look at it as a grouping, we shouldn't expect it to outperform equities over a long run. Okay, that's number one. Number two is that what we can expect and what we should expect and what we're looking for is that when there's a downturn in the equity market, we expect this strategy not 100% of the time, but a high percentage of the time to really offset that equity downturn. And that's really a key that we look for, and it's something that you should ask us for evidence of. Second, the third thing that I want to emphasize is that we talked about the RMS being sort of an insurance policy. I think what's important to note too, that we expect it to have a positive return over a full market cycle. And so the question kind of comes to mind, so why are we focused on volatility? Why is volatility such an important part of the discussion today, and why do we care? Well, it's a very simple concept in finance. It's what's called volatility drag. And without getting into a long dissertation, I'll just make it really simple. We have average returns, so we kind of talk about that. But the reason why we don't achieve what really matters is compounded return, and that's really the most important thing that we kind of talk about. And what causes compound returns to either is the volatility. So by lowering the volatility, that will help improve the compounding, and that's simply it. And that's the key reason why we focus in on volatility and in this exercise. So bottom line is what we're trying to do is through this exercise is help the plan achieve the 7.5% return, but smooth out the path in terms of getting there. So what I wanted to do in terms of just, I wanted to look at some more recent history, life history. And if you go to IMV 113-12, okay? So I just wanted to draw your attention, and what we've done here is that we're looking at global macro and trend following. And so what we've done in this exercise here is that this is for the global macro, this is the life history since 2011, and we look through September 2015.
Stephen, let me jump in real quick. For the board members, that's the supplemental information that was posted on the web, I think just yesterday, so that's why it's -1-2. You should see it on you should be able to see that on the public website. You can't hear me now. There we go.
Okay. Do you guys have access to it? Okay, great. Thank you. Yeah. So -1-2. And so what I'm going to, there's two charts. There's one that's labeled global macro during all negative S&P 500. Let's see that. Okay, great. So I'm going to speak to these two charts. So what you're seeing here is really our live experience. And so with the global macro, through December 2011 through September 2015, it's been 46 months. Of those 46 months, 14 of those months, or 30% of the time, the S&P 500 was negative. In 13 of the 14 months where the S&P was negative, global macro had a better return than S&P 500. Again, showing its reliability and its diversification benefits. So now if you look at the top 2 worst months, and so let's just go to August 2015. This is where the S&P 500 was a negative 6.03 versus global macro. Again, this is the performance net of fees. It was significantly less negative at 1.05%. So a difference of about 5%. Second worst negative month was May of 2012. S&P was down a negative 6.01%. Global macro down a negative 1.33 or 4.68% difference. So next I wanted to draw your attention to is the bottom where he talks about trend following. And here we have a shorter record. We actually started the trend following in December of last year. And so of the 10 months, 6 or 60% of the time, S&P 500 had a negative monthly return. So 5 out of 6, though, trend following, again, had a better return. So again, similar to global macro, we see evidence that it's providing the diversification benefits when it really matters, when the S&P 500 has a drawdown. So I just want to draw your attention again to the 2 worst months, and that's August 2015. Like I stated before, S&P was down a negative 6.03%, trend falling down a negative 1.4, a difference of about 4.6%. In January 2015, S&P was down a negative 3%, trend following had a positive about 7.6, so a larger spread here of about 10.6. So the takeaway I want you to have is that with these 2 strategies, there's strong, compelling evidence that it does what it's supposed to do. For staff, this is just part of our, when we look at a strategy and we look for evidence that it's supposed to do what it's supposed to do, I just wanted to share with you a couple of things we look at. There's other types of analysis that we do to prove out its efficacy. Okay. So the last thing I wanted to talk about is diversification. So one of the things that we talk about is diversification when it really matters. And so what Chris alluded to earlier and he talked about is that left tail risk. So what we experienced back in 2008, and we thought we had a diversified portfolio, a lot of our assets correlated towards one. So everything went down, and probably treasuries kind of stood on its own and helped diversify the portfolio. What RMS does is that it brings into the mix other types of assets that will help the plan really fight when there's a drawdown in equities. It will provide that buffer. So the last thing I wanted to talk about is efficient implementation. We're very cognizant of wanting to bring forth a plan that there's enough capacity. So because we're contemplating, we want to make an impact on the bottom line, we need to make sure that each of these strategies, there's enough capacity that we can go out there and put substantial dollars to work. But what Alan said earlier, though, is true. It is going to take a while. We have to pace ourselves, but there is enough capacity. Part of the efficient implementation is what we think about a lot is cost. And so I want to assure you that we do our best job possible in terms of trying to think of going out to the market, and when we find a strategy is to find the managers that, first of all, that we think could do the best job for us. When we identify those managers, what we want to try to do then is negotiate terms and conditions that we think are favorable to CalSTRS. We do the best job that we can. And one of the things I think that I'm really proud of our work, and one of the things that we've made a lot of progress in is trend following. And trend following, we we didn't get the 2 and 20. We're actually, in terms of management fees, we're about 50 basis points now. And the good news is that if RMS is approved and if we were to increase the size to trend following, we have negotiating powers to bring those fees down lower. And we think we could bring the management fees down to probably about 40 basis points. Okay, in terms of the incentive portion, right now it's around 1% or 100 basis points. And so we'll make efforts there to see if we can make some progress in that area. But the point is that when we brought it into the innovation portfolio, one of the disadvantages we have is that we didn't have size, so we weren't able to negotiate the fees that we think were ideal. But now with coming in size, what we would do is that before we would allocate or give the managers larger dollar amounts, we would come in and essentially renegotiate the terms and conditions so that we get lower fees. So, hold on. So what I want to do next is Carrie's going to go over one other chart here. The reason why we wanted to go over this chart is I just wanted to give you a little bit of color of, we have these 4 strategies, so why? Alan alluded to its diversification benefits. So the way we kind of think about it is we think about diversification at various levels. The first thing that we always think about is RMS and how it diversifies the plan. We just kind of talked about its value there. The next thing is the reason why we have 4 different strategies is that within strategy itself, we want to make sure that we have strategies that are not highly correlated with each other. And this is really an important point, and the reason why that's so important is that we want to develop an RMS strategy that gives you essentially a sleeve that can do its job through the full cycle, if you will, of a drawdown. So we want to kind of tackle all aspects of the drawdown. And here we will just go into a little bit how each of the strategies sort of accomplish that. So Carrie?
So this SMILE chart, it shows a combination of the 4 strategies. The solid blue line represents the monthly return for the combination of the 4 strategies plotted against the S&P's monthly return on the x-axis. And with the combination, you get basically a superior insurance product that can protect you through different phases of the cycle and how that cycle plays out. So the first 2 components that have the largest weight in RMS, Treasuries and trend following. Treasuries are expected to react immediately to a shock or crash in the market. And trend following will pick up if that downturn is extended. But it takes time for these rules-based systems to identify that trend. So in the interim, global macro can step in those inflection points and find opportunities before trend following picks up. And then when there's a reversal in the cycle, trend following can suffer, but global macro again steps in to find opportunities in that middle part or inflection point in the cycle. And as we come out into a positive part of the cycle, again, macro can step in, then trend following picks up again if that cycle is extended. So each of these has positives and negatives about when they perform throughout the cycle, but the combination of them just creates a more robust insurance product. And then systematic risk premia is there to provide an uncorrelated return, typically more in the normal quieter periods. It won't do as well in the extreme negative periods, but it helps reduce the cost of that insurance product. And we don't know what the next crisis will look like, if there will be a trend or if it will be range bound or very choppy. And so it's important to have several tools in place.
So I wanted just to conclude is that I wanted to go back what Alan stated earlier, is that we have PCA, Makita, and staff. We all agree that RMS is a valuable tool for the portfolio. And assuming that RMS works, is that portfolio will be able to maintain its long-term expected return at 7.5%, but get there on a smoother path.
Anything else? Is that We're good to go? Okay, great. Thanks so much for the presentation. And so we now want to offer it open to statements from the public. Again, I'm just going to remind you, statements from the public related to the asset allocation study. We have no one? Okay.
We'll take a little break.
Yeah, so we'll take a 5-minute break. It's 3:02, so take 5 minutes, and we'll come back, and we'll have Harvey, our fiduciary counsel, and board discussion. So take a 5-minute break. Thanks.